according to the election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Fear how I feel, then you feel that's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Fingers to the down.
All right, ladies and gentlemen, I got your watch list coming in at September 21st, 2021, and we need to talk about the real reason why the market went crazy today. And I got 3 stacks that I'm looking at coming in at tomorrow, but we have to go over a lot of different things. A lot of things happen. I have a lot of pretty pictures and data for you. We're going to go over all of the Evergrande bonds, or I'm going to give you a little bit of the hints. We're going to talk about the technicals. We're going to talk about the volatility in the VIX, and then we also need to talk about how some areas of the market are not responding at all to what we got today. So I'm jumping right into it, and we're going to talk about a lot because today was absolutely wild. The NASDAQ was down 3% at one point. Every other index was down over 1.5% or 2.5%, and this breaks the 40-day streak of not seeing a 1% move, and this was the largest downturn from top to bottom that we've pretty much seen since last October, since we got to close barely higher than where we touched. It did not hit the 5% correction, but essentially this is our first time seeing a 5% move down in a very, very long time, almost a year. But all in all, we have to go over a lot of things and talk about why did we see this response? Why was the Dow down over 1,000 points? And what does this Chinese real estate developer, why does it affect the whole market? Why is it affecting tech stocks? This is what a lot of people were talking about today. Some people were saying this is well overblown. Even Kalanovich said to buy the dip. So there's a lot of differing opinions. But to give you the simple answer that we've been going over with the watch list, this is not just because of Evergrande. There is 3 other things, and that is pretty much what we need to be going over. So we got a lot to talk about. I want to go over everything that happened in the market today, all of the little factors I'm looking at, even the American CD swaps. We're going to go over a bunch of different stuff, the plays that we made and what we did with our plays from Friday. Some of them, we hit them right on the head, and then everything we got for the rest of the week. So let us not delay. You guys know what you need to do. Drop your thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes for open. It's the first link in the description, and it's pinned in the comments. We better see you there in the morning. It's free 99. It costs you nothing to join. YouTube.com/TheStockMarket. You can post the plays, see the plays, watch the watch list come to life, and yes, if you were going to buy the dip, but you RSVP'd and you didn't end up buying the dip because you saw it broke below the 50-day, then led to the 100-day, but you were RSVP'ing and you know you're going to do it and you're going to buy the dip, but you still haven't bought the dip even though you said you were going to buy the dip, then yeah, we're the place to be. And the most important thing you need to do, post your watch below. Let us know what you're looking at. Got any plays, comments, remixes, anything. Post them below and source that info. Chat at the chat, baby. So right off the bat, we have a lot to talk about. I am going to jump all over the place to highlight everything, but to give you something pretty early, and a lot of people are talking about this, or maybe they're not really talking about it, but this move today wasn't just about China. This has to do with the United States and our debt ceiling. We even got some moves after hours, but the big factor that's probably slipping beneath the surface here is this is the United States credit default swaps, or essentially the spreads on them, and then the wider they go, that's usually indicating volatility. But you can see here on the 3-month range, I'll pull it up to the 6-month range, but the spreads are at the highest point they've been in 6 months. The average is about 12. The low is about 11.3. We are at 15.3. But then again, when you go and look at the chart, I mean, it really just highlights everything for you. This is over the last 6 months, but we could even pull it up back on the last year. You're seeing the spike up out of nowhere. It's not too high just yet, but it pretty much is bringing you right back to the GameStop stuff, or right before the GameStop moment happened. And ironically, that's when the CDSs dropped. So this is part of it, but it's to highlight the debt ceiling aspect. But now there is still a lot going on with Evergrande. So now these are the big bonds in question right here. And this is the 8 1/4 Evergrande bond that is supposed to mature on March 2022, and now they have an interest payment of $80 million on Thursday. So we brought this one up a couple of times already, and we discussed this on yesterday's watch list, but now after seeing the reaction today and what happened with Evergrande in Hong Kong, and even the Hong Kong markets in general, this is going to be key. But shout out to some of the Chad reporting out there. They also have a bunch of other bonds that are pretty much going to be maturing either very soon soon or are going to have payouts in pretty much the next few days here or even the next coming weeks. And again, this is what our first pretty picture is showing you. Here is the security identification numbers of all of the Evergrande linked bonds that at least some United States banks have exposure to. So we don't know who exactly, but I do believe JP Morgan at the least has some exposure to all of these. But as you start to enter them, what they're going to show you here, again, you see different bonds. They have bonds ranging from 11.5 yield all the way down to an 8.25, which is the one that's focused on now. But essentially, my conclusion with this is that what we have going on is pretty much running a lot deeper than a lot of people would suspect, but it is bringing up questions because some people are saying this is a little bit overdone, because if we want to come and take a look at some of the junk bonds here, I'm going to go to another pretty picture. Junk yields ever since the fiasco with Evergrande, they have not moved or widened at all. So this is leading some people to suspect that, well, the contagion may just not be that big as people are suspecting. And even though you saw a risk-off event, it is starting to kind of lead to some irrational sell-off. So there is a lot of confusion in the market. But to pretty much explain everything that we got today, today was all about Evergrande, but now there is a lot more to it. This game of chicken between a bond issue with China or now a bond issue in the United States, our debt ceiling, that is starting to go. And some of the actions taken today in Congress, that did set off another shot, which is beginning the race between, okay, what's going to happen with this debt ceiling and are we going to run out of money? And again, does it lead to another bond issue? Not to mention Powell on Wednesday. Now, that is something that we talked about today because it's very unusual to see a big move happen the same week of Powell. If you remember last September 2020, the stock market did come down a lot, but it moved the week prior to Powell, and then the day after Powell, it was able to move a lot bigger. So this case, it's pretty interesting because we kind of moved leading into Powell, but we didn't see a move of this scale, and now all of a sudden, with Powell 2 days ahead of us, we are moving big. So this is going to be very, very key. So watch how that moves the market coming into Wednesday. But then, like we said with that 8.25 bond, Thursday is going to be the moment of truth. And there, we will get to see, okay, how is the Evergrande situation playing out? Are any of these fear warranted? Or the worst case scenario, what could this spread to and what sort of financial impact can this have? The scary part about all of this is that pretty much we still know very little about Evergrande, and that is the scary part. Somebody asked today, why is this such a big deal? And the effect is at two levels. One, how does it affect the local economy in China? Again, if their citizens lose money and it leads to a collapse, this is a real estate developer. Some people don't realize the problem with Evergrande is that people have given them money to build homes and they're not able to build the homes, but they've taken people's money and they employ a lot of people. So that's one factor. But now the next level, if they can't pay back their debt, what is that going to imply now for anybody who's holding the risk, or if any of our banks have invested in them, or in general? Again, the scary part, we don't know how deep this runs. They have a lot of different liabilities. They make up about 16% of the high-yield credit market in China, but they have the largest amount of liabilities for a real estate developer in the world. So nobody comes close to what they're holding. But again, we don't know who's invested in it or not, and that's why if there is a default, if it leads to shockwaves, that's where it starts to affect some of our finance. This is what people are calling the China Lehman moment. Now, coming to what you saw in the market, this is partly in part why we went crazy. Again, I'm trying to say that Evergrande was a big part of it. However, you still got Powell on Wednesday, and the main thing and the main importance of what we got today is that it shows that the market isn't all about tapering. The fact we moved from other instances, it highlights a lot, and a lot of other stuff is happening now, but you're getting to see the market move not related to Powell, even though we're going to get him on Wednesday. Then you have the debt ceiling, and now on top of it, this buy the dip level, that 50-day moving average, it is not broken the whole year. We have cleanly broken below it, and we have closed there, so we'll see the level of conviction. But now, even after today, we actually ended up hitting the 100-day moving average. So that was the joke that we made here today, because a lot of the traders in general, or at least the technical ones, they've even used the 100-day as like the backup moment. You haven't ever needed it. Again, you could take a look all year. You've only had one real break in March over the 50-day moving average, but we were able to recover nice. We're firmly below that now, but look at the 100-day. Last time you touched March, that was November, or even the bottom of last September. So to see the 100-day kind of match up as we're approaching a similar day, that one's interesting. But now this is like the real second, last call, last chance buy the dip moment. So depending on how this holds up, that is key. But that is also what is leading some people and analysts like Kalanovic to say that today's move was primarily just driven by technicals on top of everything else. A lot of people are saying that what you saw today could have been an overreaction, but then a lot of other people are bringing up, you know, how unusual what we saw here today was, and this is now the VIX spike, and even what I'm kind of worried about, because essentially you've seen what the gamma squeeze could do to a stock like GameStop, but what happens now when a lot of options expire, they get wiped up off the table, there's a certain level of exposure in the market, then people start piling into certain trades, and then the volatility kind of starts this snowball reaction. What could happen? A Volmageddon, more or less. But that's what has some people talking about, because what you're seeing in the VIX, this is the most it's ran up pretty much since 2020. And the last time we've seen that was the 2018 issue at the beginning of the year and towards the end. And then 2015, 2016, where China devaluation and European financial crisis vibes started to hurt things. So this is what has a lot of market participants pointing to, okay, maybe the United States is finally responding to some of the growth concerns outside of its home base. And if it gets bad enough, as history has shown us, that could negatively affect us. So putting this all together, you're seeing there was a lot of impact today. And that's why even data to say, okay, well, maybe it wasn't just Evergrande. I could stand by that. But what we got today is very, very key. And then where we move from here is also going to be important. That's what I'm saying. A lot of things may happen for the rest of the week. And whatever we get up until Powell, I'm really going to regard it as info, whether it bounces big or drops big. I'm not going to get too caught up in it, because whatever it does, it will give us more confirmation as to, okay, what is the real driving force behind the market right now. And then post Powell is probably going to unlock a big move. So after Powell speaks, then I'm expecting a bigger move Thursday and Friday to come on. And then whatever happens Thursday with Evergrande, that is going to say a lot about when and then how much the Evergrande situation is really going to affect us. So for this week, you need to keep your eyes on everything related to China, what's going on with the debt ceiling, what's going on with Powell, and then the other little trick here is going to be the U.S. credit default swaps, as that is kind of popping up out of nowhere. And if that starts to go crazy, it is starting to point at worry stemming from what we are doing in our decisions here, even though we have a lot of other stuff going on overseas. So coming into the company news and events, we got this in the morning, and this one could be hinting at some scarier stuff here, but Coinbase has decided to drop their lending progress, and it's hinting at SEC regulations on crypto. Some people are speculating that the SEC is going to do full-blown crypto regulations, and they plan to treat crypto pretty much like a commodity or something that is attached with the future. So that had some effect today. We'll watch as that plays out. Even crypto, again, they are reacting to all of this, so that one's key. And then this gave us a boost for some of the European stocks and even travel stocks this morning, but the United States has now opened up air travel to most vaccinated foreign passengers. There was a little bit of back and forth on this, because Saki got questioned on why the people crossing border on foot don't have to do any testing or proof of vaccination, whereas the opening of travel that has just came out today is pretty much hinged upon foreigners being vaccinated. But overall, a very good positive for the reopening trade. So there was that. And then this is the primary reason I think the CDS went up today, but the Democrats have dared the GOP with a hardball move by linking the debt limit to some of these spending bills that account for hurricane and disaster relief. So what they're trying to do, we talked about this yesterday, they pushed it forward, and this is now what I'm saying. It kind of sets off a warning shot, or the game of chicken has really began, because by doing this, the Democrats are pretty much now trying to get a little bit of extra support from the Republicans by linking these bills. But essentially, if the Republicans hold their stance that they don't want to participate in raising it, then this will make a lot of things actually fail a little bit quicker, and we could even run out of money pretty much by the 15th, within a month. But essentially what they're trying to do is get other spending bills that the Republicans need to go through, and they're trying to attach a stopgap to it to pretty much freeze the debt ceiling so that it will buy them enough time till after the midterm, and then it gets us away from this problem. But essentially, by taking this risk, the odds of a actual government shutdown now have actually skyrocketed. So keep your eye on this, and depending on what happens from there, we will see the market reaction. But there was that. Then ConocoPhillips, they agreed to buy the Shell Permian assets for $9.5 billion. They are now the largest oil producer in that region, and they plan to use the money, I believe, or Shell does, to give money back to some shareholders, dividends and buybacks. So you've been seeing that trend lately, so watch out for that. Then Lennar, their outlook for homes disappoints. Again, they hinted at more supply crunches, but they were dropping, and this one could have been a bright spot with some of the housing data we got, but now that the builders are kind of warning on guidance, that was very negative. Again, another company piece of news, SRAD, they got Michael Jordan to join their board of directors, so gonna keep my eye out for that one tomorrow. I thought that one was just cool. And then finally, the SEC opens an investigation into Activision over some of the workplace stuff, so the stock got a little bit of a hit, but we'll see how that one plays out. But that is pretty much it for the news. Everything else has been very straightforward. The market knows what it's looking for. We have a bunch of events this week, and pretty much by Friday, we are really going to get an idea of how the investor sentiment is looking and how we're setting up for the end of the year, so I hope you're ready. But that is pretty much it, so let us get into the plays. So right off the bat, I got 3 or 4 different stocks that I'm looking at coming into tomorrow, but the first play I want to highlight is HSBC. We made this play on Friday. If you guys were watching last week's watch list, we were talking about Evergrande and how we got into this one, and this was related to any of the contagion related to Evergrande, because you've been hearing about this. That's the ironic part, is that it has been weeks of people worried about this situation. Today was kind of that boiling point, but if you were on stream, you watched us make this play. If you got stream alerts, you didn't miss it even if you weren't there, but they went absolutely crazy today, and it seems like all of a sudden, and you could tell this is why we even like the play. Initially, we were talking about it being kind of a liquid and not really getting that much focus, but it seems like the rest of the world today got this idea of Evergrande contagion, and then they started looking at different banks, and that's why now HSBC is important, because it comes up in our bond analysis as we start to look at all of the different bonds, and you see the creditors. BlackRock owns 1.89 of the 15% that is reported outstanding. Again, the numbers are crazy, and even as I gone through all of the CUISPs and I was looking at them, these don't change. So the data is even limited, and you guys see the platform that I'm using. You know, there is still a lot that is uncovered, but one thing that was noticed, HSBC's on there with BlackRock as well as UBS. We made a play on UBS today, but the real kicker is that a lot of these companies that have less exposure than BlackRock, they are a lot smaller. So this is what makes it interesting, but again, today, everybody started to go crazy. They went for the HSBC, so we bought 100 of these. When we got these on the 17th, that was the first day that they suspended the bonds for Evergrande, so kind of could correlate it with the catalyst, but I got these at 8 cents for the January 15 puts. These shot up in value. They were up as much as 300% today, but now the move that I did, and if I had a lot of contracts on this, this is probably what I would do here too, and you could see we already got 30% on this. We were even thinking about closing it out and then reopening it, but I said we'll leave it be, but I ghetto spreaded the HSBC $10 puts $5 below, so we own the right at 15 bucks, but then essentially we agreed to sell somebody the puts at $10. So you could see here on the option chain, here's the 15. It's closer to the money. I bought these for 8 cents. So they were trading as much as 40 cents at one point, and that's around when I did the trade, because these contracts, the $10 ones, these were going for 20 cents. I think I got them right around here, and instead of buying these ones, I shorted them. So we own these ones. I short the $10 ones. I pretty much turned this single option into a debit spread, but since we bought them cheaper, we are walking away with credit. This is what we call the ghetto spread. If you watch my video, it's called How I Turned 500 into 50,000. We have a full tutorial doing this with another big play, but the best part in this case, since there's such a big difference between the contracts, $5 and I have 100, this allowed me to take profits on the play while still having exposure and making sure that if the stock did bounce, we would lose zero money on this trade. So you see here, I was able to sell about 93 of them, 94 for around 23 to 20 cents. I collected about $1,800 or $1,900. You can see by the net liquidity and then add the gain to it. But essentially, I paid $800 for these 100 options. I sold premium on a worse option for almost $2,000, collected $1,800. And essentially now, if these plays all go to zero, I cannot walk away with less than $1,800. And then if the stock keeps dropping, let's say I get assigned on this play. If someone said, what if you get assigned here? here. If I get assigned here, that means I'll be in the money here, meaning I will get a max gain of about $50,000 because I have 100 contracts. So that's the best part about this play, and that's pretty much what we did right here. I'm guaranteeing myself a 300% net return, and then if the stock keeps dropping between now and January, again, because I'm expecting this situation to take some time to unfold, we could still make an additional $50,000. So that's how I'm going to be playing that. That's the first one. The second play is going to be UBS. So like I said, they have exposure to the Evergrande bonds as well as the stock, and this is something that I think a lot of people have overlooked in the whole process of everything going on, is that yes, there are banks that own the bonds and have that exposure, but there is a lot of people who actually own the stock itself in Hong Kong. They have access to it. Again, BlackRock is their 12th largest shareholder, owning about 0.35% of the equity. Again, they are a very big company, but everybody, even UBS, they show up on here as well too, along with HSBC. But now the logic with this play here in general is the exposure to Evergrande. But if you went and go and look at the options did not move at all considering the move. They were down 5-6%, but you were able to get premium a year of time on it, or a good amount of time, that wasn't even up like 20 to 40%. So it was very interesting. Again, very illiquid, not a lot of eyeballs and crowding on it. But the downside is there is a lot less meat on the bone. HSBC or UBS stock, it's not like HSBC. Even HSBC is kind of cheap, but UBS is even cheaper. So even if you get puts and the stock goes down to zero, I mean, you're going to be limited as far as how much you could actually make because you still need the stock to drop. But the part that I do like about this stock in general, if you come here, you'll see it is above where it was in 2020, whereas if you compare that to like HSBC, it is a completely different story with them struggling and not ever bouncing back up as one of the big banks. And again, their exposure to China and some of the bad parts of Europe there, that's why we liked HSBC in the beginning. But now that we know UBS has some exposure, it doesn't really move a lot. It's kind of a liquid. I thought we'd make a good play, so I grabbed the February $10 puts. I grabbed 50 of these. I kept it a little small, essentially took the ghetto spread profits from HSBC and put it in here. Grabbed 50 of them for 20 cents. And again, this is what I'm saying. This is a 2-year chart, but these same options were going for 20 cents or less about 2 months ago, and even before that they were trading about 15. So yes, there was a lot of time decay and you're paying the premium, but if you go and look at it, this chain was relatively dead. I mean, besides the Colt here, you could see the open interest was 21, and some of these have open interest of 0. And if you even go back and compare that to the HSBC, there was 5,000 options on this today, but when we bought it, I mean, our open interest, I believe we were the 1.8 shares. I don't think the open interest was high at all. You see today it's at 1804, but the volume was 1.8 that day that we got in there. So to give you an idea, this chain looks active and was looking very crazy, but kind of reminded me of UBS. However, at this point, we're responding late, so there is going to be risk. So just be careful with that one. And then finally, I'm going to be watching Nike and Starbucks. Both of them have China exposure, and this is now not looking at Evergrande as much as it's looking at the Chinese consumer, or if we get any more Chinese regulatory stuff. I think Nike is definitely on the chopping block, but I do think they could go both ways, meaning if some of it does get situated, we could see some upside. But a lot of people are saying, would you go at Alibaba, anything like that? I'd rather go for one of these. But I do have an old Nike play, and I did add to some on the earnings. I just got a next week 120. I got like 5 of them for 29 cents, but I'm going to be holding those. Want to see how they play. They're going to report tomorrow, so keep your eyes on them. But as far as everything else, you know, got a lot of other plays. I did sell out of the Airbnbs. I got these Friday puts, and then they went up about 200%, so I sold half of them for $1.16. They were able to nicely hedge my share position, so I still got 5 more, but made those free and some. Then I had old Facebooks come to life, sold one of them near the bottom, got $3.35 in profit, or I was up 200%. Then I sold these Wells Fargos that I had. Our XLFs are still up, and then this morning I did make a UVXY play. I spent about $200 for a debit spread. I wanted to see to get exposure, and this is what I also did with Shopify. These ones went up 30 or even 50%. I think they closed at 37 after the bounce, but this is what I've always been saying. Yes, you could get ahead of it early. You see what happens with HSBC, but even this morning, you could have bought the HSBCs for 10 cents, and then even with some of the other plays, I was able to grab them this morning and make money, like the Shop. That one went up as much as 80% at one point, then came down. But these were the other plays that I made today. Took some profits on some other stuff, and a lot of other graveyards came back to life, so I'm going to be writing these out and seeing just how they perform in general. But the main focus throughout the rest of the week is pretty much going to be a lot of the stocks and names that we're looking at, as well as to see how does this story develop in the next few days. So watch out for them. JD, again, Baba, our old plays came back to life, or now they're up 60%. These ones have been moving slower, so I still think there's an opportunity to play them, so watch them. And then watch Viacom. They kind of came back to life a little bit, but I like these on the bullish side last week. They're still on that table. We're down on those plays, but keep your eye out for them. Then Lucid, I want to see if it has another good day. They got that positive EPA news a couple days, and then they led the way as really a big leader when 90% of stocks were down, so that was key. Then XLF, big gap down, especially on an ETF, and those premiums have now came back. They're up 40% on the longer term one, so going to be watching that. And then SRAD, this is the Michael Jordan company, and then Apple, Amazon, Shopify, but Apple and Amazon, watch these to kind of be the leader wherever they go from here. This will say a lot. And now I also have the UVXY up. Surprisingly, we were watching this a lot more than TLT or the dollar today, because surprisingly, you got some level of stability. I mean, TLT is literally just at the level it was at a couple days ago. The dollar didn't move too much. You are seeing it go up, and we do need to talk about the back and forth depending on what could happen with China bonds if it leads to the yuan strengthening, but there is going to be a lot of back and forth. Essentially, do not underestimate the dollar's ability to strengthen, then quickly weaken, then after the weakening shoot up, or vice versa. Whereas essentially what I'm saying is that the Chinese currency can strengthen, that would weaken the dollar temporarily, but then once the real reality sets in after the first initial drop, the dollar will continue to shoot back up again and play its little dance, pretty much reacting to the liquidity tightening. So keep that one in mind. But then as far as just TLT and in general what we're going to watch here, I will be watching the UVXY to give us velocity. And I think this might be the main key this week, because if we're going to respond to everything overseas, if it's going to look like 2015, 2016, you want to see volatility in the gamma squeeze on the UVXY occur, because that's probably going to show it. And clearly it is showing us more than the dollar and bonds. But either way, a lot is going to happen, and we are going to need time, and every day till Friday is going to tell us a lot. So I hope you're ready. But that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure you post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shine. I need you to remember cause and effect, baby. What's the law of nature? But the code loves you. I love you. I'm gonna see you in the morning. Let's go.